Hello everybody, welcome back to the WillssFX channel. I'm back with another video, and in today's video I'm going to talk about how to trade with small amounts of money, specifically around £10. Been getting a lot of messages on my Instagram, which is on the screen now, about people with small amounts of money and they want to trade with it. And basically in this video I'm going to tell you my tips on how I've been able to obviously grow small accounts, which I've showed on videos and stuff like that, like the 10 to £1,000 challenge that we're doing. But yeah, I'm just going to go through my top tips on how to grow an account from small to large amount of capital with quite a small risk as well, not like those flip videos which you see 10 to a million, stuff like that. All load of rubbish. So the first few trades on this account are actually very, very crucial. And obviously you've got to use a very small lot size if you're using MetaTrader 0.01 lot size. So say you're using around a 25-30 pip stop loss with 0.01, you would lose about £2.50, £3 per trade. So you have around 3 to 4 opportunities with those first 4 trades to actually blow the account if you lose those first 4 trades. But yeah, you have to be very selective with the first few trades you take, as they will build up the capital for you to be able to obviously have that cushion for the losses. So say the first 3 trades you win, you'll probably be around £20, £30 maybe. But yeah, that's why you've got to win the first few trades. Otherwise, yeah, the account will be down to a very small value. And obviously, you'll only be able to trade this amount of capital if you have a fairly high leverage. Say you've got 1 to 30, you probably won't be able to trade gold or some of the more volatile pairs because you just don't have the capital or the margin to be able to actually trade these pairs. If you're doing this personally, I'd say a 1 to 500 would be a good amount. I know some brokers don't actually offer that, but go with a broker which offers that and allows you to trade with a small amount of money with a low minimum deposit like the one I use. The next point is actually don't trade really volatile pairs. These can include gold, US30, GBP, JPY. You probably won't be able to trade US30 anyway because of the small account balance, and obviously it's such a high pip value on that pair. But especially like gold, it moves a few hundred pips a day, so you don't really want to be on the wrong side of that. Even with a 0.01, 100 pips minus £10, you'd lose your whole account on that if you didn't actually place a stop loss. Trading volatile pairs is obviously good if you have a decent amount of capital behind you. So say after the first few weeks or so, if you're being profitable, have a bigger account balance like £50, £100 maybe. All depends on your trading and how far you are into your trading journey. The next pointer is to always use the same lot size. So obviously for the first £100, £200 you've gained on the account, I'd say you should only be trading 0.01 lot size. This is obviously because of the margin and the leverage on the account. They won't allow you to trade bigger lot sizes anyway, and they only limit you to 0.01. And say you're risking 30 pips per trade with 0.01, that's £3. And even on a £100 account, that's 3%. On a £10 account, that's 30% of the account. So even if you're risking 30 pips, 30% of the account is at risk per trade. Obviously, you still want to use the same small lot size even after a winning streak. You probably win a few trades in a row, the account's doubled, and you think, I've sorted this trading thing out, I know what to do now, I'm a professional. But no, the markets will soon slaughter you. Obviously, as quickly as you become profitable, you can become overconfident in your trading, using bigger lot sizes, risking more per trade, and your losses can just come as quickly as the profits came. Going on from this topic, you should never revenge trade or overtrade after maybe a losing streak. You've lost 50% of your account. You probably think, maybe if I just risk double on this trade, that I can get my losses back quickly. When this happens after a losing streak and you've started using bigger lot sizes to revenge trade, this is when your emotions get involved in the markets, and this is when you can make serious losses and your psychology can just go out the window. I've seen many traders do this where they've made some losses on their account, they're down a very large percentage, and then they just stick on a big lot size to just make those losses back, and it always ends badly. They always end up losing even more percentage of their account, which they have to gain back over time, which obviously takes a lot longer. After a losing streak, traders usually let their emotions come into play. They start trading recklessly. They start using bigger lot sizes, risking more, but by using the bigger lot sizes, they actually end up losing more overall. And they just don't really seem to care about the money they're losing because they're just trying to trade to make back the losses. The mistake that most traders make is using incorrect risk to reward. In your trading, you should at least have a 1 to 1.5 or a 1 to 2 risk to reward ratio on your trades. So that means, say you risk 50 pips per trade and your take profit is 100 pips. If you lose 50% of your trades, you're still profitable overall. Because say you lose 2 trades, you're down 100 pips, and then you win 2 trades, you're up 200 pips. Overall, you've gained 100 pips from these 4 trades. Say you use a 1-to-1 risk to reward ratio on your trades with a 50% win rate, you're going to be at break even, which is good. And obviously the main aim of trading is to protect your initial capital. But yeah, you've got to let your winners run to the take profit. Don't cut them early as soon as you see blue on your chart. A lot of traders leave their trade to run to the stop loss because they just think that they're always right in the markets, and if they just leave the trade, then it'll reverse back into profit. They end up losing the trade, hits the stop loss. But with the winners, they cut it early as soon as it's in profit because they just want to secure that profit. They don't like having the trade open for hours or days in some cases. They just want to get the profit quickly, and this can actually ruin your trading, and it's called toxic trading. Closing trades out at break even, and most brokers actually charge commission. So say you're closing it at break even, you lose half of that through commission to the broker. So there's no point just closing your trade out as soon as it goes into profit just because you're letting your emotions into your trading. You've got to just let your trades play out, and if you can see that it's reversing, go in the other direction, just close out the trade. Don't just let it run to the stop loss in a small chance that it could reverse into your take profit again. And the last bit of advice I'm going to say is, instead of trading with £10 and just losing it over and over again, depositing more and more over time, it will all add up to hundreds of pounds. What I'd advise you do is actually, instead of investing all this small amounts of deposits over time, actually save that money and learn how to trade, because obviously you can't trade with money without the right education. So I'd say just practice on a demo, complete a few months of chart analysis which has gone correctly, and then with the saved up money you've got, you can focus on the trading part and getting the psychology in check, because you can't actually teach psychology. So it's all about hours and hours of chart work and actual live trading. But as long as you've got the backbone of the knowledge of the trading, then the only part that will be holding you back is the psychology. And this just comes over time with trading the live markets. But yep, that's all for this video. I hope you enjoyed and learned a little bit from this. Leave a like and subscribe, and I'll see you in the next one.